In today's video, we'll be talking about potentially finding the new Lehman Brothers. Apologies for lack of uploads recently. I just didn't feel like there was any change in my mindset and change in kind of this environment from what I mentioned in previous videos. These are the topics we'll be going over today. First off, we'll cover up SVB, the Silicon Valley Bank, what happened there. Then we'll talk about crypto banks and Blackstone. Not really related. They just they just all fit in the same slide. Then we'll talk about the U.S. financials, how they're not doing too well. Then we'll talk about Powell's testimony in front of the House and the Senate. Then we'll cover up with equities market and how the equities market's finally catching up to the big picture. And we'll talk about the energy picture and finally cover off with precious metals opportunity. Taking a look at Silicon Valley Bank, it is not a very big bank in the financial sector, but it is a crucial lender in the AI and tech sector when it comes to venture capitalists in that sector as well. And it's having liquidity crisis. And it failed to find a buyer today, and it has now been closed by the regulators. Now, what has happened? Now, let's take a look at its balance sheet. So we can see that on the asset side, only 1/3 of its assets are loaned out when it comes to making loans to these VCs, AI, and tech companies. And then, like the big banks, who their assets are mostly loans, it's only lending out 1/3. So what's the rest of the money doing? Well, over half of it is being used to buy treasuries and MBS. So it's kind of following what the Fed is doing. So being, quote, like conservative, because supposedly treasuries and MBS, it's quite low risk. Don't look back to 2008 when it comes to MBS, but on a normal setting, we would expect treasuries and MBS to be very, safe, risk-free, and the reason why SVB does this is because on the liability side, meaning deposits, a lot of their deposits was non-interest paying, and it's because of how they structured it and who's putting money into these banks, and with the AI kind of heat wave that we just had, and that's kind of why it was going well for some time. But the problem is with a lot more cash coming in, because again, with all the AI hype, the liability side, we're seeing a lot more deposits, and with interest rate hikes, the interest costs have increased significantly. But at the same time, in the asset side, we're seeing a crash because with bond yields with interest rates going up, bonds prices fall, at least existing ones. And so what we're seeing is the assets are falling while liability upkeep costs is increasing. And so that's why we're seeing the liquidity crisis. And as of right now, they failed to find a buyer and has been closed. Now let's take a look at Crypto Bank and Blackstone. Again, not related, they just all fit in the same slide. Silvergate, a crypto-focused bank, shutting down its operations and liquidating its assets. Signature Bank, CNBC said, Wells Fargo is buying it. It's the last game in the crypto town. Like, again, I've mentioned my comments about crypto from day one. To me, it is just a big Ponzi scheme. The technology with blockchain is revolutionary. However, these currencies are just Ponzi schemes. And if you're interested, you can look back to one of my videos that I've detailed why to me that they are Ponzi schemes. Blackstone we talked about previously in the Fed put optimism video, where they continue to have problem with their MBS. They now default on their Nordic property backed MBS, and like they've always been blocking investor withdrawals in their REIT fund since February. So along with all that we've just covered, we're seeing a lot of the, crypto banks, a lot of financial sectors are having trouble. Now, why is that? Now, let's first take a look what happened yesterday. We have, all these big banks in the US having its worst day since, for a few years. Charles Schwab really took a big hitting. And what's the reason? And the reason is with the inversion. With the short end, we saw 2 year, now it's not as high anymore, above 5%, and we see the 10-year is not hitting 4%. And what that means is that the cost for financials are much higher than the revenue. And why is that? Because for financials, they borrow in short term and they lend out for long term. So meaning, for example, you put money in the bank, you buy a term deposit, or you put money in it in a savings account, whatever. The money you put in is liabilities for the bank because they owe you money. But then they take that money and they lend it out, they make loans. But these loans are much longer term, like mortgages, 25, 30 years, car loans, or business loans, whatever. So they're lending, their assets are much longer duration than their cost, their liabilities. And when you have a yield curve inversion, their costs to upkeep the liabilities, their interest costs, are much higher than their interest income from their loans, which are longer duration. And so what happened with SVB will most likely not caused any financial sector liquidity because it is a small bank. Meaning, I don't think any of these big banks will fail because of SVB. But the key crucial point here is what happened to SVB will most likely happen to big banks as yield curve inversion continues. As their interest costs continues to be higher than their interest income and continue to put pressure on them for liquidity crisis. And that means that puts pressure on the Fed because are they going to let all these big banks fail, or are they going to say like, hey, these banks are too big to fail again, like what they did in 2008. So Lehman Brothers, it was not like one of the biggest banks. It was coming. It's an upcoming, very aggressive bank making pretty good money. But the fall of Lehman Brothers, triggered a lot of different problems that others did not see before. Now let's talk about Powell's testimony. So Wednesday in front of the House Committee, very hawkish. Stating that rates need to be higher for longer. Again, a video title that we had before. Feel free to check that out. And he really stayed strong when being asked about how what he's doing is causing more job losses. Elizabeth Warren really came out saying like, hey, how do you talk to those people? The 2 million, 4 million people who at this rate of what you're doing will lose their job. How do you respond to them? And, he really should have just said like, hey, I'm doing this for all of America, and if, a small portion of population has to suffer for the benefit for everyone else, this is something I'm willing to do. But, he didn't have the balls to say that. So he just kind of brushed it off like, oh, we're not trying to cause job losses. We're focusing on inflation, and whatever happens. Thursday, after a big drop on Wednesday, Powell knows that he doesn't need to be as hawkish anymore because he saw the big drop in equities. So he was a bit less hawkish, mentioning how they will be data dependent. And so what happens is one day very hawkish, another day not as much, after a big drawdown in equities. So this puts a lot more pressure on the jobs data and inflation data that is coming up before the March FOMC meeting. And let's see if they will really deliver, because prior to the meeting, prior to the testimony, market was pricing in just 25 basis point hike, and the hilarious rate cuts pricing in for the remaining of the year. And now market has gotten rid of the rate cut pricing in, and now we're pricing in a 50 basis point hike in the coming FOMC. So let's see if he'll deliver that. Taking a look at the equities market. So finally they're getting starting to get the message that rates are going for higher for longer unless we have some sort of financial and liquidity crisis. And the Fed will not pivot until we have a drawdown in equity prices. So again, equity market was trying to front run the Fed pivot, but the problem is Fed would not pivot until there's a drawdown in equities, or we have some kind of financial and liquidity crisis, which we could potentially see in the with the financials, right? So maybe that is a sign, but again, equities, until a crisis occur, equities like the pressure is downward until Fed pivots, downwards pressure for equities. And another thing is valuation has really changed. With bond yields much higher now than what it used to before, stocks have become even more overvalued. Or if they were, if they were okay valued, now they're becoming overvalued. And if you were overvalued before, you're really overvalued, given the alternative to what you can do with your cash, right? What if we see a big shift from retail investors? Like, they've been in the equities market, they're not doing anything, and they're seeing, a risk-free quote. Again, we were quoting risk-free investment in treasuries, for 2-year, 5%, right? Why don't we shift over to the fixed income market, right? And that will cause an even bigger drop for equities market. Will we see, a run for the exit then? And another factor is we're seeing a lot of gambling, retail crowd gambling with these 0 day till expiration options. And this is a massive bet on a daily basis, because these have, it expires today. And if it doesn't hit your target, you lose all of your money, which is crazy. And which is also why we saw the VIX stay below 20 for quite a while. Because the VIX reflects, much longer term options. And the question is, will we see Volkswagen 2.0 in equity crash with the records of derivatives trading with 0 day expiration options? Well, we'll see. I think it is quite possible, and it is a very dangerous game. Now let's take a look at the energy picture. So natural gas, this has been the really interesting for natural gas, because it hit a historic low with a much warmer than expected winter in EU, and US Henry Hub is reopening for shipping. And so the idea here for natural gas is, if it can hold the $2 bottom, then we can see a sustainable rally as we rally off the historic low, because as we approach summer again, if it depends if summer is going to be cooler than expected, then we might have an issue. But if summer is warmer than we expect, more energy usage in EU, and potentially if anything happens with the Russia-Ukraine picture, maybe there's more implication when it comes to natural gas picture. But because it is an historic low, this is kind of a value play. For oil, Brent crude has a crucial trend line at 81 and a crucial support around 77. This has to hold. If it doesn't, then oil will become bearish. So there are various factors, with recession risks, with recession happening, less energy is required because, people aren't working as much, they're not spending as much, they're not going to places as much. One bullish factor would be the SPR refilling, with the Strategic Petroleum Reserve, significant drawdown, and the White House hoping to refill it below $70. And the question is, how much more do they have to sell? And then when are they starting to buy it back? Because if they start buying, that's, a bullish factor. And finally, we had, EAE potentially walking out of OPEC Plus, because right now they act as a cartel, together to work as, close to a monopoly. Obviously, it is oligopoly is a little bit different than a monopoly, because you have parties that try to cheat, meaning produce a little bit more. But if OPEC does break up, then that is more downward pressure for oil. And finally, let's talk about uranium. I suspect the recent drawdown in miner prices, it reflects the recent fall in other energy prices, in oil and natural gas. But this, I think, provides a good opportunity to buy in, as the long-term picture for uranium has not changed when it comes to nuclear power. Finally, let's talk about the precious metal opportunity. And so precious metals have been front-running the fall, along with matching the dollar the whole time, while equities continue their fallacy of soft landing, Fed pivot, and all that. And now we're starting to see that yields are looking that they've peaked. We have record shorts in bonds, and now that equity market is finally catching up to the Fed's message. Possibly we're seeing more investors going into bonds, so that puts, again, more downward pressure in yields, and that means upward pressure in bond price. And with yields falling, we're seeing DXY, also the US dollar index, also falling, because if interest rate in a currency is not as high as it used to be, now it is not as favorable to have cash in that currency. And again, this is the thinking. If the yields have peaked, if dollar index have peaked, DXY has peaked, then we could see a sustainable, rally with precious metals. Again, obviously, we really depend on the Fed, where precious metals potentially is sniffing out the policy mistake, where economy is weak, the Fed is tightening. We could see, liquidity crisis occurring, and we're seeing potential signs of it in the financial sector, with SVB being, the prime example. Are we going to see that in the bigger banks as well? And with the risk increasing, precious metals who front ran the Fed tightening, unlike equities still playing catch up, it's sensing a future pivot by the Fed to avoid a complete collapse in the financial markets. I think this move might be a little bit premature, but we'll get a confirmation, or at least a better picture, once we get to, the March FOMC meeting in the press conference, to kind of see what, the Fed is thinking, and also the dot plots. And until then, we have all this financial data that's coming out when it comes to jobs and CPI. And then once we get there, then we'll see, until then, do we have any potential liquidity crisis? Again, my thinking is the Fed would not pivot until either a significant equities drawdown or a liquidity crisis. If those happen, and the Fed pivots, then stocks will go back up, dollar will keep falling, bond yields will continue to fall, precious metals, commodities will do well. But until that happens, there's no clear picture. And the only reason why precious metals are rallying, I think, in my opinion, is because they already front ran all the fall, and now they're starting to sniff out a future pivot. Thanks for watching.